Hello, everybody, and thank you for joining. At the moment, we can see that participants are still coming on, so we are going to start in just a few moments. Stay with us. Well, we've reached the top of the hour, so I am happy to welcome Aegis Network as our LECP sponsor for the NAIFA Live. And I have known Aegis Network for many years. Actually, I worked with them successfully, I might add. Probably my best years in actually selling long-term care was when I worked in the worksite arena. And now as a member, I am so happy to bring you a session with them. Even though they have a large sales team, I will say one of the things that is significant about the Aegis Network is their technology. For example, during the whole Washington Cares Trust plunge, they were able to process by having such upgraded technology, more apps than you and I could imagine, something like 1,000 a day. So I won't now introduce the actual speaker, Kevin Sipniski, but I will ask you to please look at their biographies that you can find on LinkedIn. With that, I'm not going to take up any more time. Kevin has a ton of information to share with you. So with that, Kevin, please.
Thank you so much, Carol. Really appreciate the opportunity. I'm going to go through a whole bunch of stuff here, and feel free to type in any questions in the chat, and then we'll go through those after we've finished, and we'll be sending out answers to some of those. If we don't have time, we can send out answers after the fact to the group that is registered. I'm going to go ahead and share my screen and get started. This might be a little different than you're used to from a pure insurance discussion, because we're also going to talk a little bit of caregiving, because we believe that when you're talking to the work site, caregiving issues are now as big a deal as the long-term care. Back, 20 years ago, when we were starting to talk about work site, long-term care and caregiving, the long-term care was certainly more prevalent is a topic than elder care. And by caregiving, I mean elder care, adult care, just not child care. Well, today it's kind of turned around, and that it's a big deal now. And so our approach is we help talk to the employers and employees about caregiving and provide resources in that area, because that's really the employer's ROI, right? If their employees better manage the caregiving. But then you can't avoid the discussion of retirement readiness and long-term care financing. So those two really go hand in hand, we think, in a more holistic way than just talking about one or the other, because as soon as you talk about caregiving, you have to talk about resources to handle those caregiving things, which resources are usually money, not always. And if you're talking about the financing, that's an important issue as well. But most of us at 50 are not looking at our long-term care event tomorrow. We're helping our parents with theirs now. And so we think those go pretty well together, and have found most employers like approaching it from a more holistic standpoint than just a long-term care insurance product. And in the old days, it would take us years to get this much press from the business press, but it is a deal now. And especially with COVID, the need to stay out of a nursing home to keep our loved ones safe is more prevalent than ever. And it is the business press now. It's not, the soft fluff press. This is hitting employers right between the eyes. But what we find, and this is a slide we actually use with a lot of the employees, is we find that the biggest issue with family caregiving is they don't self-identify. If I ask you if you're a caregiver, you might say no, but yet you're already cutting dad's grass or shoveling mom's driveway. Well, you know what? Dad used to cut his own grass. So you are a caregiver. And at some point on this journey, you'll get that you're a caregiver. But the sad part is everything you can do to make it better is early on when you just think you're being a good son or daughter. And so what we really want to push is awareness sooner so that you can take the proactive steps that can avoid the fall, that can avoid the long-term care placement in a facility. Because once mom's fallen and broken her hip and she fell on that throw rug, the doctor telling you to remove the throw rugs is a little late. And you would be amazed at the number of individuals that are, put into nursing homes because of a fall. And one of the number one reasons for falls are throw rugs and clutter and cords around the house. And those are things we can change. And it often starts with something kind of minor and we don't see it as really caregiving. And then it becomes more, and here's this, insurance professionals, we know the ADLs, we know, yep, that's caregiving. Well, the reality is it was caregiving up here. And if we can help people understand and start talking in the family about that, then by the time they get here and mom's already had her second stroke, you know where the safe deposit box is, you know where the long-term care insurance policy is, because the saddest thing that we hear, and we've heard it from every long-term care insurance company we've talked to, is that they often get claims filed 12 to 24 months late. And sometimes the person's deceased. And the whole reason for that is because they just now found the policy. And they were cleaning out a file drawer and that's where it was. And when you look at it from an employer standpoint, why is it hitting employers now? Well, because of the average age, right? Most workforces, when I was a Unum rep, were, 30 something. Well, now they're 40 something and hitting head on with the caregiver age. And if we take the average worker and give them an extra 30 hours of work each week for 3.5 years on top of the kids' gymnastics and everything else, you can imagine, obviously, yes, that becomes an issue. And we all have talked about the productivity and we all know that, right? Absenteeism, presenteeism. But the bigger thing that we're now seeing is the health cost, because caregivers don't eat right. They don't sleep right. They don't exercise. They go to the doctor all the time, but they go to mom's doctor, not their own doctor. And someone that medically was compliant with exams and all the things that they should be doing skips that for a number of years, 3 to 5 years. You skip your, appropriate exams. And the next thing you know, we have stage 4 cancers for people that previously always had their exams. Caregivers, and this is a study from, unfortunately, it hasn't been redone. This is a study from 2012. So about 10 years ago, $13 billion a year in increased healthcare costs. And that's something that can really, really hit employers hard, and they're seeing it. And we're all talking wellness in the workplace. Most employers are talking wellness. Well, if you're talking wellness and saying you should eat right and, sleep more, but you don't help me with the thing that's causing my unwellness, which is caregiving, it kind of really isn't that helpful. Now, most employers have managed FMLA, managed family medical leave. And once the carriers manage your family medical leave, you can get data. And when we get that data, we can see that the person that takes time out for themselves because of a family medical leave for a parent or spouse is more likely then to become a disability claim themselves. And you kind of figure, why is that the case? Well, it's because when we're helping our parents or a loved one, we burn the candles at both ends until we're a puddle of wax on the floor. And then we raise our hand and say, I think I need to take my medical leave. Because with kids, we take medical leave up front, right? Early on. With parents, typically, we wait till the very end and then we just collapse. Well, that's unfortunate. And you can see the days lost to parents and spouse. We just looked at a large employer last week, and 40% of their leaves, their days leaves, right? How many days lost in the workplace? 40% were due to parents and spouse, right? And yeah, 60% are still kids, but 40% are adult caregiving. And that wasn't the case 20 years ago. And so how does an employer, deal with this? Well, you have to start the conversation, because every family goes through these same issues, right? And you'll go through these same issues with each parent sometimes. And so they're the same issues, but if we just talk about them, right? With kids, we share these stories. No one's giving us the book, What to Expect When We're Expecting to Be Caregiving, because most of us don't expect to be caregiving, right? That's the challenge. We're just thrown into it, and no one gave us the book, and no one gave us 9 months to prepare, and no one threw us a baby shower and gave us all sorts of tips, right? Well, the issues are there with caregiving, just like they are with kids. We just need to talk about it more. And the answer to some of these is, why won't my parents listen to me? I always kind of smile and say, it's payback for high school when we didn't listen to them, right? Teenagers are wired to not listen to us. I guarantee most of us are wired to not listen to our adult kids, especially once we start losing abilities and they're telling us what what we should be doing, right? It's just the way it is. Find someone else that they'll listen to. Same thing with the keys. How do you get the keys away from dad? You got to ask the doctor for help. You got to ask the neighbor that's their age, their sibling, their priest, their rabbi. Someone that's not the kid needs to help address this. And there's lots of tips on how to begin these conversations. We'll show you some later. The other thing that is advisors, everyone should be talking about, is the level of fraud and abuse that's going on in the workplace in seniors' worlds today. It is horrid, and no one's talking about it. And the frequency is way higher than you would expect. One example I would tell you is most home care companies don't require national criminal background checks, or many don't. You'll ask, do you do background checks for your workers? And they'll say yes. They do state, driver's license, that sort of thing. They're not going to the National Criminal Database in many cases. So make sure you're taking that extra step. If you use a caregiver from care.com or some of those websites so you can pick a caregiver, pay the extra $300 or $400 to have the criminal background check done, because there's people that are going around the country stealing and abusing seniors. And as soon as there's any suspicion, they switch locations and go to another state. And for corporations, we just have to start the discussion, right? It's not about spending a bunch of money. It's about starting the discussion in the workplace, assisting employees by having support groups and lunch and learns. There's people out there that want to help support. We just have to welcome them into the situation. One thing that we do, and these are almost all public websites that you could use as well, we've just kind of done a mashup is what this is called, where we link them in to a platform that we share with employers. But these sites are mostly public sites that you could use as well. And what we do is put in things that we know they need, but plus things that they already have, right? Most employers have an employee assistance plan down here in the lower left. Well, we promote that. Most large employers have prepaid legal. We help promote the prepaid legal plan. We don't have anything to do with those. The health insurance broker perhaps put those in, but we support the cross-pollination of those programs because you're going to need them, right? You're going to hire an attorney through this, odds are. Employee assistance plans are very good with elder care now. They weren't very good 15 years ago, but they got it wired now. And then we add in things that we know you need. This is a free platform to consumers called CareTree that is a storage place for medical records and prescription lists, as well as an open access area where you can post things about mom, how she's doing. There's a sign up genius on here as well, where you can say, hey, can someone take mom to the doctor on Thursday or out to dinner on Tuesday? So people can interact and you don't have to manage it all by email, right? And then the medical professionals can also use this platform to communicate with each other and the primary family caregivers. Free to the consumers, because the geriatric care managers pay to use this platform, which also connects you with a bunch of geriatric care managers. For those people without insurance, and there's plenty of us out there that don't have long-term care insurance, here's a platform called Benefits Checkup. It's been out there for 22 years plus, that'll find you benefits, state and federal programs, either discounted or free programs that are out there for you to use based on your zip code, your financial situation, and it's run by the National Council on the Aging, a watchdog group for seniors. And after 20-something years, no one knows it's there still. But it's top-notch way to get help for low or no cost. And there's other platforms out there as well. If you reach out to us, we'll be happy to take you through them. But now we want to talk, some of the actual long-term care side of this. Claims data. This is from Genworth's claims block. So they're the largest payer of long-term care claims. And I'm really excited about this data. And if you're not as much of a data geek as I am, I think you'll find it interesting to some extent, because what Genworth can tell you is that 76% of claims start at home, assisted living, or memory care. That means 76% of claims start not in a nursing home, right? And where does everyone not want to be, especially after COVID? No one wants to be in a nursing home. No one's ever wanted to be in a nursing home by and large. If you have insurance paying for your care, the claims don't start in a nursing home. But the exciting finale to that is almost 70% of claims don't end in a nursing home if you have financing, right? You get to stay at home, you get to be in assisted living, you get to be, in memory care. And Alzheimer's is a terrible thing. I've got it going on in my family with my stepmother right now, and it's terrible, and I feel bad for her, but I don't feel bad about the place she's in. That's a lovely place in St. Louis at about $7,000-8,000 a month, but she has insurance and it's taking care of it. And while I feel bad for what she's going through, where she is lovely. And we've got that peace of mind. But that would not be the case without insurance or real finances. The sad thing is the vast majority of nursing home residents are not having skilled care. These are skilled nursing homes that most people there are having custodial care, which makes no sense. They shouldn't be there. But as you know, that's where Medicaid still defaults to, right? So what we say is financing this event is the way to avoid the nursing home. And once you show people this data, it helps bring that home, right? 70% of people that end their long-term care claims don't end in a nursing home if they have insurance. And if you've seen what went on in the state of Washington with the payroll tax to help fund Medicaid and long-term care, this is why they had to do it. 62% of nursing home residents are on Medicaid, and almost everyone I would bet on this call knows that the average nursing home cost is over $8,000 a month in this country. And Medicaid's paying less than that, but they're still paying a lot for more than 60% of the residents. So hence you have the state issue, right? A NAIFA slide here. NAIFA's done a great job of keeping us all on track with understanding what's going on in the different states. But, we are not going to solve this Medicaid crisis without some support from long-term care insurance, right? It's a real thing. It costs real money. And most of us aren't going to have $5,000, $6,000, $7,000 a month to pay for this for a number of years extra, in addition to our retirement living needs and our spouse's retirement living needs. And that's what people are seeing is the employees go through this in their 50s. They're understanding, oops, I should be buying this. The good news is since we work with all employer groups, our average buyer is about 51 years old. And as you know, 51-year-olds can afford it more likely than a 65-year-old, and 51-year-olds can pass underwriting more likely than a 65-year-old. And that's the other reason we need to get this in the workplace. And we had done a lot of workplace long-term care back in the, call it 2008 through 2010 or 2005 through 2010 or 12, and then it evaporated overnight. There's still carriers in the game. They're just different carriers. Here's the interesting thing about what Washington did. You all know ADLs if you've done long-term care before, but what Washington did that I thought was horrid was they made cognitive impairment one of the ADLs. It wasn't or cognitive impairment to qualify for a benefit. It was and cognitive impairment. So you had to have 3 of 10 ADLs, of which cognitive impairment was one of them, right? And so my stepmother is an example that I already used, is severely cognitively impaired, needs to be in a memory care unit, but she can bathe, dress, toilet transfer, continence, all that's good for her. but yet we're paying $8,000 a month. In the state of Washington, that plan wouldn't be paying her yet because she hasn't lost another ADL, which is atrocious that they design a plan for the state that doesn't meet their own state insurance department's regulations. But that's what happened. So you guys know this, but I just thought that and versus or, you know, when it's legal language, one word makes a difference. And so how we talk about this in the workplace is a broader overview of retirement readiness, retirement wellness, right? Everyone goes, well, yes, I can use some of my retirement for long-term care. And you're right. That's not a bad idea to use some of it. But we've also got, you know, we think of the golf and travel, but it's food and shelter. But our generation going forward has post-retirement healthcare. And part of that's long-term care. And we can use some of our retirement dollars, right? But we don't want to use all of our retirement dollars or most and then leave a surviving spouse. And what we've really focused on is funding home care, right? Funding assisted living, fund the $40,000 to $60,000 cost versus funding nursing homes at $8,000 or $10,000 because that insurance is incredibly expensive. You're buying $10,000 benefits. And as you saw, most people don't need to be in a nursing home anyway. They might go into, you know, for rehab care, but then they come back out, right? And get home care or assisted living. And so we talk to employees in the baby boomer generation about fund your home care, fund your assisted living. And, you know, at $40,000 a year, 2 years, okay, that's $80,000. They say, well, that's fine. I can cover that. Well, no, that's mom's care today. If we put any inflation factor on there, and then you say, hey, I'm married, it's still a big number that I really don't want to make sure that my retirement dollar, and if I do need a little bit of nursing home, then I'm in even a worse hurt. So talk to people about having a plan for something else besides just my retirement dollars so that when I have an event, right, it's coming from not only my retirement dollars, right? And there's more options today than there's ever been, right? I know NAIFA just did the reverse mortgage webinar. Reverse mortgages make a whole lot of sense in a lot of cases these days, right? And you've got the Life for the Long-Term Care Rider, both on the work site as well as the One America and the Money Guard and the, you know, higher end products. But there's also the Life of the Long-Term Care Riders in the work site. And then obviously there's, you know, traditional long-term care insurance and long-term care annuities, et cetera. But that's what we have to start talking about, and not, hey, you have to buy insurance. Hey, you have to have a plan that's not just drain my retirement savings. And so when you look at the players, and I'm talking more work site here, so I'm not specifically not saying anything against the One America, the asset-based products, the Money Guard. Those are just more individual products than what we would see as a work site product. Hopefully one of those carriers will come out with a work site product. We'd certainly like to see that. As of yet, not, but we hope so. So these are some of the players in the traditional long-term care space. Some of them you've heard of, right? You might not have known that Unum's still in this business. They've got probably 8,000 plans still out there, still active, still putting people in. You just can't put new plans in place, but their legacy plans are still viable. Genworth's trying to get back in this business sometime this year. You've probably seen some of the notices that they're trying to launch with individual, and then they'll do a work site after that. And then you've got some of the carriers. These are not the exhaustive list of every carrier in both these markets, but just some of the more common ones that we've seen and see used. Some of these carriers on the Life of the Long-Term Care side, depending on how they write the language in any subsequent state that takes on this type of challenge with an opt-out, having a policy. Some of these, like Transamerica's was a critical illness rider. It wasn't this, 702B rider. So would it qualify? It's going to be up to the state, up to the carrier with their opinion. But not all of these plans are exactly the same. But here's what we've done is just a quick comparison. We've got one that goes about 4 pages long, and we're going to spare you that. But when you just look at this, to get to a common $3,000 a month benefit, you're looking at a traditional long-term care policy about $100,000. The Life for the Long-Term Care, it's $75,000 because they pay 4% of your face amount. The traditional products offer inflation riders if you want them. The life of the long-term care riders usually don't. The benefit durations vary. We use 36 months here. The life of the long-term care standard would be 25 months, but some states allow for an extension of benefits rider, which doubles it to 50 months. It's about 10% more in cost, but we're like, really? Double the benefits for 10% more? We try to load that in every time we can. The real difference comes in the underwriting. Long-term care is going to be underwritten some level, right? There's no guarantee issue out there. The life of long-term care has guarantee issue, which is a win, right? No one gets declined. Well, there's good and bads to both sides, and we'll walk through this. The other good thing about the life of long-term care is there's a death benefit. Even if you use your long-term care, they usually have a restoration benefit, which allows you to get some or all of the death benefit as well. And then when you jump down to the costs for a minimum plan here, like at 3,000 or a small plan, not vastly difference in cost at the younger ages, but as you start to go up in age, the cost can get prohibitive on the life of the long-term care side. But think of that. Why? Well, one, it's guarantee issue. So it's going to be, there's got to be a rating factor for that. And then two, you're guaranteed a death benefit, whereas the long-term care side, we haven't, added a death benefit in there. So you're looking at, potentially two liabilities for an insurance carrier. So you can understand why it would be more expensive. But it's a great, think a lot of people end up with both, right? Because at some point you might buy permanent life insurance that has the long-term care rider. And then years later, when life insurance, long-term care is more pertinent to you, you'll buy a long-term care policy. We often die with multiple long-term care, multiple life insurance policies, right? People don't usually just have one life insurance policy. I don't think in the future, people are only going to have one long-term care insurance policy. I've got folks that work on our team that have 3 already. And so if you're trying to do some baseline long-term care, the life of long-term care rider is great and affordable. But once you say, hey, I'm a 50-year-old and I'd like to buy 300 grand of long-term care, then the life of long-term care can get kind of prohibitive. But again, it's guarantee issue. So, that there's a value to that, and you're going to be guaranteed a death benefit. So there's value to that if you're trying to solve for a life need and a long-term care need. Most of the life of the long-term care plans won't guarantee issue up to 300. Usually the highest we see is 100 to 200,000, something, and that is about the max guarantee issue, depending on the size of the employer. The smaller the employer, the smaller the guarantee issue amount. But they're both good solutions. Both solve, similar needs. Some, obviously different with the life need as well. But we like to show everyone the good and the bad of all, because what we talk to employers about now is, do you want to do traditional only, which is going to be higher long-term care amounts, spousal discounts, shared care, inflation riders, really robust long-term care. But the carriers don't write the young people, right? A lot of them aren't going to write 30 and 40-year-olds, the NGLs and the mutuals of the world. Life Secure still writes down to 18. The life of long-term care, great long-term care benefits, still paid on an ADL basis, guarantee issue, and we'll write down to age 18. Cons to it is it's more expensive unless you're just buying little bits of long-term care, and most of them don't have inflation. Some of them have some inflation riders, and they're not going to write over 70 for the long-term care, but people shouldn't or usually can't buy long-term care over 70 anyway. But the other option is to do both, not at the same time, do them subsequently, right? So do the traditional long-term care first, knowing that people are going to be declined, and tell everyone when you get declined, we'll have another product later that is guarantee issue. And people say, well, then why not just do the guarantee issue one? Well, if you look at this slide here, if I want 300,000 and I'm 50, I really don't want to pay $400 a month for my long-term care. If all I want is long-term care. If I want the life too, then maybe 400 a month isn't too bad. So we've done both in a lot of cases, because you get the full benefit of long-term care and its robust offerings. And then you come back with the long-term care, because the younger people like the life insurance. They really don't care that much about the long-term care. It's nice that it comes with, with the package, but they'd like some permanent life insurance. And we also notice that most employees across America do not have permanent life insurance, right? Unless, they've worked with an independent agent, don't have permanent life insurance. We all have group term life, which is wonderful, but that's not going to do squat for us when we retire, right? Even if there's retiree life in our group term life, it usually doesn't exceed $5,000. So offering the traditional first and then coming back later with the permanent life with the long-term care covers the declines on the long-term care, allows the younger people and anyone with a permanent life insurance need to get some life insurance on top of the group term life that they're going to take into retirement at the same rate, right? You started at 40, you're paying the same rate. And a lot of these build cash value. So we priced one out the other day, fairly minimum benefit. I call it, I think 75,000 face amount. Buy at 35, by 75, you got about 40 grand in cash value. So that's not to be sneezed at either, right? So different products help with the same situation, but also serve different needs as well. And again, I would not roll them out together at one time. I would do the traditional first and then the life and long-term care maybe the next year or later in that year. It solves a lot of different needs. Also, the traditional long-term care has amazing tax incentives for the employer, right? If you all are financial advisors on this and you have any closely held businesses, especially C Corps, that are not spending their profits on shoring up the executives and principals long-term care risk, that's crazy, right? You're paying taxes and leaving your largest unfunded personal liability unaddressed. And you could do it with corporate deductible dollars, with tax-free benefits, and you can discriminate. We call it carve out, not discriminate. And then employee paid premiums, as you probably know, some states offer deductions, some states offer tax credits. And I think we'll see more of that as states try to figure a way to get more and more people to increase the purchase of the long-term care. But I can tell you over the last 2 years, even before this state of Washington thing, even before that, there was been a resurgence of long-term care interest. And I think it's just time and the baby boomers and us 50-something-year-olds realizing we don't have this problem solved, and we're watching our parents go through it in all too many cases without having the problem solved. So, a lot of long-term care going on in 2010, 2005, 2006, kind of what we called the long-term care nuclear winter was probably 2010 through 2016, 17. But over the last 2 to 3, 4 years, employers are in this game again. And then, every employer out there, every large employer out there almost has an HSA. If you're in a high tax state, you're going to knock 40% off of your long-term care costs, right? That $1,000 policy becomes $600, right? If you're in a high tax bracket in a high tax state, that's some serious savings, right? And that's savings not once, right? I'm not buying a washing machine and I save it 30% and then don't buy it again for 10 years. This is a product you're going to save the tax, pre-tax on for the next 40 years if you buy it at 40 years old. And the other thing that's changed in the worksite is technology. Yes, we had the internet in 2005, but people didn't trust the internet and the platforms weren't as flexible. So, this type of thing, and we're not the only ones out there, but we've built this and other folks, some of our friendly competitors have built these as well to allow people to self-enroll. And then you support them with a call center. You support them with a chat function if you want, but it doesn't require you to sit down one-on-one with every person, right? You could support them, let them ask questions. And here's a news flash. A lot of people don't want to sit for an hour with an insurance agent, right? If you answer their questions, they're good with that. They don't want to have you take the app for them, right? They can do that themselves, but we also limit some of the options. We're not showing every single option by every single carrier, but then in the videos can help sell the need, help explain, spousal discounts. And speaking of spouses, we've been doing worksite long-term care, as Carol said, since, I mean, I've been doing it since the early 90s when I was a group rep, but in this world since about 2000. And in the worksite, in the early days, employees were guarantee issue back in the old days, and spouses were fully underwritten. And so we would always get interest in spousal enrollment, but because we had to send in paper back in those days with the E of I and the paper app, spouses were interested but never applied. We saw less than 5% spousal enrollment in the old plans, and I'm being generous at 5, it was probably more like 2. As soon as we took this online and asked this one question, are you married? Do you want to see plans on your spouse? All of a sudden, 49% of the applications we receive come with a spouse. 49%. And we know not every person is married that we get an app from. So that's most married people are sending in a spousal app as well. It just makes sense, right? But you got to make it easy for them to do that. The evidence of insurability is all online. They don't have to type it in. They're not doing a fillable PDF. This is an engine that asks them questions and populates the application in the background. If they're declined because of any of these knockout questions, we stop them right there, right? We're not submitting knockouts or the height and weight. We know, what those charts are. So we stop them at the height and weight if they're, a foot too short. So, it can make it easy. And then you have the opportunity to offer an alternate product, because every time someone's stopped in the system, you can see that right on the dashboard, and we can go help them and say, would you like an alternate product? Would you like a short-term care product? Would you like a life for the long-term care rider product? If it's available. And then it's just all done with DocuSign, because people are comfortable with DocuSign, and there's other, there's Adobe Sign and et cetera as well. But the key is not making them fill it all in and do all that. Just ask them questions and populate it in the background, but let them do it on their own. Or if they want hand holding, we'll do that too and take the app for them. But most people would rather not sit for 45 minutes and answer questions when they can just do it online, and they can stop and start it, right? They got to go look up their doctor's address, or they don't remember, what the milligrams are on that medication. They can come back and save it for later. And then again, the tools that are out there today make this so much nicer, right? Being able to schedule an appointment online, when it's a good time for you and your spouse, right? And know that someone's going to be available. I learned about this at the ILTCI conference, I guess back when we had ILTCI conferences a couple of years ago, about acuity, right? I heard several of the speakers talking about acuity, and I'm like, what is that? It sounds like I got to get it. Sure enough, and I know Mark Glickman uses Calendarly. So there's great tools out there. They're so affordable, but it allows you to engage with employees when they want to engage. Right? And you can set time aside. It works with your calendar. But then if they just want to pick up the phone or send an email, you can do that as well, right? And again, most of these plans allow for family enrollment, whether it be spouse, whether it be extended family. So build tools that help with that, right? Little videos of why would you care about family, right? Employees aren't used to parents or siblings being eligible for their employee benefits. So we might say, well, we've told everybody that, but it's completely new to them, completely not something they've seen before. So you have to remind them, because the other thing with long-term care is they don't pay attention till it matters. So you got to make sure you're coming back year after year to talk to the people who've now been through this in their family. Sorry about that phone ringing in the background. And then make it easy, right? Just shoot an email off so that the family can deal with that. And then, again, technology, it's not mailing costs, right? We don't have to mail out tons of material, right? It's electronic communication, it's videos. And you can make, the videos are now easy enough to do that you can make what we call the scribble videos, right? You can make those up in 30 minutes with a little practice, and you can customize them to every employer out there. It makes things super easy. And then you brand everything to the employer, because that's critical too, because they don't care what's coming from Aegis. They don't care what's coming from, Trustmark or, National Guardian Life. They care what their employer is sending them. So that get that branding done by the employer makes all the difference in the world in the acceptance. And then we actually ask the employers to send it out because it won't go into spam if it's coming from HR, or less likely to go into spam if it's coming from HR versus Aegis. But here's the exciting thing. This is one of the platforms we took electronic for Unum. And so we have an electronic platform for Unum if you find any of the old plans, and they're great old plans, still well-written contractual wise. The rates are still competitive, even though they've had multiple rate increases depending on the state. But we've been doing the Unum plans since forever ago. And we did the same effort, right? Communication, sometimes live meetings, but Unum wouldn't let us take it electronic until 2018. And so as soon as we did the same effort we've been doing for 10 plus years on the same accounts, look what happened to the enrollment. The enrollment skyrocketed, right? And then it stayed up the subsequent years. And so that's the other thing I would tell you is don't get depressed if you have single digit enrollment in long-term care when you roll it out to employer, because it's not what you start with, it's what you end with. Because if I'm 30 or I'm 40, I'm not paying attention to this, right? Most of us haven't experienced it yet. But by the time you're mid 40s, mid 50s, you've probably dealt with this, and then you're going to pay attention, and then you're going to buy it. So every year we go to our employers and do new hire enrollments. And we open it up to everyone that's not a new hire too. They have to, they might not have a simplified underwriting offer or guarantee issue depending on the carrier, but half the applications we get are not new hires. Because again, new hires are often young. They don't care. The half the apps we get are people that, and I used to do these meetings live, and people coming in the room would go, I'm not a new hire, but I should have paid attention to this 10 years ago when you were here talking about it, but I didn't. But now I've spent the last 6 months with dad in the nursing home. I get it. I need to talk about this now. And that's how it works. So we've got some accounts, and this is what I mean. It's not matters where you start, it matters where you end. This is also the only employee benefit that people keep with them for their lifetime, right? So we've got accounts in where we started in Hawaii that have more premium coming from the people that have now left the employer, ported or retired, and took their policy with them, that the premium for the retirees and the people that have left is 3 times that premium of the active people, right? It builds over time and they keep it till they die. So it really does make a difference. So, I would tell you getting this stuff done electronically, and there's multiple people out there that can help you with that. But really it's just starting the conversation in the workplace, right? On caregiving and or the long-term care financing and retirement readiness, wellness, retirement wellness. Those are all big buzzwords in the employer space when in benefits, and it fits exactly with what we're talking about here, right? And so here's one approach. If you're talking to a business owner or executives, and this is just kind of, hey, if I could show you how to solve your largest unfunded personal risk for you and your executives with corporate deductible dollars and receive tax-free benefits for your spouse and key executives, is that worth 15 minutes of your time? Right? That's a pretty simple yes, unless they've already dealt with this, and then you don't have to worry about it, right? But most people have not dealt with this. And then the other question is for the caregiving and talking to HR, if I have something that's impacting your productivity, your healthcare and disability costs, and 40% of your workforce is dealing with this, and it's going to get worse, and we could help with that, is that worth 15 minutes of your time? So 2 simple approaches that can help address these issues or get the conversation started with the employer. That's what we'd like to help with, and and give you some direction. And those are our LinkedIn. We'll have this URL for myself and Jim, who's been manning the chat box there. You can hit us up on LinkedIn. Our email is just kevin@aegisnetwork.com. Jim's is jim@aegisnetwork.com. So pretty easy on the email addresses. Carol knows how to get in touch with us, but this will be, posted out there. So what we wanted to do now is really just open it up for questions for the last 15 minutes of the slotted time. Jim, do you want to go off mute and let us know if any questions, or if anyone else wants to go off mute and ask a question live versus typing it into chat? Carol, I don't know if you can unmute folks or allow them to unmute themselves if they'd like.
We have no questions in the chat box, Kevin. During the presentation, there are a couple questions that came in the Q&A queue tab that I've since answered.
Okay, do you want to tell folks what they are in case there are questions that other people had, and
Yeah,
or were they
sure.
more housekeeping?
No, first question was, I missed, what is the name of that software, Carefree? And this individual was referring to the CareTree software that we offer at no cost to employees that gives them an efficient way to manage care for their loved ones using the Carefree technology. So it's
Yeah.
CareTree with a T. And then Ronald asked, why is New York Life not listed? And our reply to Ronald was, it's our understanding New York Life is available only to captive agents. And secondly, we weren't aware of a New York Life worksite product, but if there is one, we'd love to hear more about it.
Yep.
Those were the two questions.
Super. And just so you know, because it always trips me up on CareTree, it is caretree.me. So it's not caretree.com, it's caretree.me. And there you can go to a video, and it's free to consumers to use because the geriatric care managers pay for it. As we said, that list of carriers was not an exhaustive list of every carrier offering the products. It's the ones that we see most commonly used in the work site. And yeah, if there's other carriers, we're always looking for more carriers, as our competitors are always looking for more relationships and more carriers, because at times finding a carrier that wants the business. One area I will tell you, for the traditional long-term care, if you have a group that is mostly female, so say, 65, 70, 80% female, think schools, hospitals, they're going to have a near impossible time finding a traditional long-term care carrier that will take them, because in the work site, you have to offer unisex rates, and that can be a problem. There are carriers that will still do it, but most carriers shy away from high female contents in the workplace because they have to offer unisex pricing. And that can be painful because, as we all know, women pay a lot more for long-term care, just like men pay more for life insurance for obvious reasons.
Kevin,
Another question.
Yeah,
Yes.
sorry. I noticed that there is another question, and I think this is the one that you're going to refer to about getting the presentation. Well, perhaps I should have mentioned in the beginning that the presentation will be posted on the LECP, the Limited and Extended Care Planning Center's site. So getting the presentation without the verbal is not going to be as helpful. So we always make our live webinars available right on the site, so you can go there and access. And I will be doing that too. Kevin, there was a tremendous amount of information that you offered here. And like everyone else, I will revisit to make sure that I was able to capture all of it. So have we got any other questions?
Carol, I don't see any in the chat box or in the Q&A box at this moment.
Okay.
One thing I
then-
did want to mention, Carol, is we will all be, Jim, myself, our sales team, along with Carol and our friendly competitors, all of us that work in the worksite space will have representatives at the ILTCI conference. So if you can attend that or are attending that, please, hit any of us up. I know a bunch of us are doing sessions together. And let's go try to solve this problem for employers across the country.
Well, again, Kevin, I look forward to seeing you in Raleigh, Durham, or Raleigh, North Carolina, the ILTCI, which has, as you know, 7 different tracks. We will be there from March 20th to March 23rd. Registration is at iltci.com and iltci.org, sorry. And we look forward to seeing you. Meanwhile, Kevin, I want to thank you for a really terrific presentation, and I will see you soon.
Super. Thank you all. And please reach out to us if we can help in any way.
Thanks. Bye, everybody.